Hey there. So I thought I would just make this a public webinar if you want to watch it. I've been doing these for a number of communities around different advisor groups, and I wanted to just do a general purpose one um, for you to watch. So this is my autumn tax planning for financial advisors presentation. Uh, Basically, my main points is taking you through the actual progression that I take a client, an advisor client through for how you should be thinking about your own tax planning for your firm and for yourself and what you can be doing to get more out of your tax planning. So the basic steps that I go through with clients for this, the first is you got to know what you owe, so you need to know what your liability is. Where do you want to go? What are the goals in the business? And then we go through cashless planning techniques, things that don't cost you cash, and then we go through strategic cash moves for tax management, and then we'll talk a little bit about what I'm seeing going ahead for 2025. So I'm recording this in the end of basically mid-November of 2024. So we're going to see a lot of changes in the coming months. So we'll talk about that a little bit. So my presentation objectives here is I'm a tax professional. I don't expect you to be a tax professional. I'm more interested in you knowing the red flags of where things go wrong and the places where I see advisors make mistakes. And so I'm going to be covering some of the complexities here, but it's more just from the level of what you need to know when you're talking to a tax professional and getting the red flags to go off at the right spots. So my background is I'm a CPA with Dominion Enterprise Services. We are a CPA firm who has a niche in tax planning and compliance for financial advisors for their firm specifically. I've had over 16,000 people attend my continuing education programs. And my average rating, I think, was like a 4.7 or a 4.9 out of 5. So hopefully that bodes well for you having a good educational experience today. But I just want to say, first off, if you're not wanting to have to sit through this whole thing and you just want to cut to the chase of getting specific advice for your situation, send us an email or you can find me on LinkedIn. I'm Catherine Tyndall, CPA on LinkedIn. You'll find me really quick. Send me a DM and I'm happy to just help you triage your specific situation without you having to learn all of this stuff. But let's start with my first step, which is know what you owe. So, the biggest problem that I encounter for a lot of advisors is in order for me to do tax planning, taxes are based on profits for the most part. And so if we don't know what the profit is going to be out of the business, I don't know what the taxes are going to be. And so it's hard for me to plan and make strategic moves if I don't know the ground where we're starting. So I always recommend the first piece is having a correct projected P&L. Usually on the revenue side, that's not too hard because the platforms you'll be on can kind of predict what they expect the fee structure to be, especially if you're doing AUM. And you need to make sure you've got an updated balance sheet because something I see trip up a lot of advisors is they will do things like acquire businesses. They'll do moves on the balance sheet like paying down debt that reduce their cash, but that doesn't offset profit. And so you're still paying tax on it. And it's good for us to have both correct. And then it also ensures for me that the P&L that I'm looking at is correct when the balance sheet I'm looking at is correct. What that actually translates to for an action item for you is just making sure that you have a strong record keeping and forecasting function. So you need to make sure that you have accurate books and records, and then also that you have roughly accurate forecasts for what you're going to be spending on things. For most people, the biggest piece is just the labor cost, and that's usually predictable. Are you going to be hiring on more people? What's their expected salary? That's usually what the math goes into. Once we've got that correct projected P&L and balance sheet, the next piece is doing an actual tax forecast prior to year end so that we can make changes if we need to, and that you know roughly what you're going to, what the tax liability is so you can control it. And what that translates into is a strong tax professional relationship because it's going to be the tax professional that's doing that for you. My number one tip, if you only take one tip away, well, there's actually one other tip that I want you to take away that's later on. But if you only take away one thing from this presentation, if you want to make the efficiency of the work that you're doing in terms of making sure that you're getting the most tax savings, so you're not working for free for the government more than you have to, the number one best way to do that is having a systemized relationship with your income taxation, that you have a process, that you look at it, that you adjust it, that you adjust your behavior to be sensitive, a little more sensitive to it. And typically that's something you want to outsource to a good tax professional. So that's my number one tip is you got to have a system for this stuff. All right, so now roughly this is what you're going to have to pay in for this year, baseline if we did nothing. The next piece is where do you want to go? So you have to know where you're trying to drive the business towards because in order to take the most advantage of tax planning, it has to be in the context of what's going on in the business so that we're not doing moves in year one that are going to shoot you in the foot for year five, right? So there's basically two buckets that I see practices fall in. The first is the high inorganic growth practice. And what I mean by this is it's a healthy practice, it's growing, but ownership is aggressively reinvesting into the business to artificially lower the profit margin in order to grow the practice. And so effectively what they're doing is deferring the income taxes into the future because we're accelerating deductions and we're accelerating those write-offs in order to have those write-offs generate a return in the form of growth of the practice into the future. And so my second tip for you of tips that you need to take away is if you are trying to grow tax efficiently, having a high inorganic growth practice is the most efficient way to save tax generally when you're looking at a professional services firm. So, keeping those profits a little artificially low is the way to do that. Now, that has to be in the context of everything else that's strategically going on. So I don't just say like, "Oh, burn all the money." There's a context there, but if your general strategy is, "Hey, I'm at 50 million today. I want to get to 100 million in a couple of years. What are the strategic investments that I need to be making into the business in order to get to that? Okay, once I have enough profit in the business where I have a decent cash reserve for emergency expenditures and I'm getting enough to survive off of this for myself, where can I deploy this excess cash into my strategic initiatives in order to drive that growth?" That's the way that you do the tax planning instead of waiting until the end of the year where you've got this big fat profit number hanging out that's going to go through the tax funnel and you're going to get taxed on it, right? So the other type of practice that I see probably more commonly is the stable organic growth practice. And what this is advisors who are growing their practices in a very stable, steady way where you're not aggressively reinvesting profits back into the business. You want more stability. You're not looking to go 10x in a couple of years. You're more interested in the just having that steady eddy growth and steady profit margin and not having the risk exposure of that high inorganic growth. And so for those types of practices, the more traditional tax planning techniques like retirement planning, taking advantage of tax advantage accounts and those sorts of things tend to make more sense. A couple of other things I want you to think about. First is if you're going to be selling the practice anytime soon within the next 5 years, we want to make sure that we're coordinating our tax planning with the exit planning and with the valuation planning because I don't want to be doing tax moves that are going to screw up your multiple. Long story short. The other piece is acquisition. So if you're going to be acquiring other practices, we need to be actively thinking about what are the cash needs going to be for those acquisitions, what are the financing needs, and what are going to be the additional operational drags that are created, right? Especially on the cash side of this, acquisitions can create significant cash drag because what happens is when you buy out these books of business, typically you can't write it all off in the first year. You're going to have to amortize it over several years. And so you've burnt a lot of cash, you've acquired this asset. And if part of how that was financed was out of your profits, right? You got a big profit, went to your cash, you spent the cash to acquire the practice. That's going to translate into you still have to pay the taxes on that profit that gave you the cash, but the cash is no longer there because you spent it. So just making sure you don't get caught in a vicious loop there. One piece that I recommend that every advisor do, whether you need it or not, is having a line of credit, having as much as you can have, because you never know when you're going to come across one of your advisor friends who's, got a cancer diagnosis and wants to sell off half of his book tomorrow for you to be able to just say, "Yep, I have the cash flexibility for it. I've got a line of credit I can tap to buy you out." And figure out the cash. Obviously you need to forecast and everything, but if you have that line of credit sitting and waiting, it allows us on the tax side to do the math and say, "Oh yeah, no, you should do this move. It makes total sense." So another piece of advice there for you. So the know where you want to go, what's the current year liability as is if we do nothing? Next question, what can we implement this year between the cashless and the cash costing implementations and making sure that those make sense? And then the next piece after that is what is the strategy around doing estimated tax payments? Because a lot of advisors that I talk to and a lot of tax professionals I talk to, the tax professional will say, "Hey, advisor, you made X last year. Here are some estimated tax payment vouchers. They're 110% of what you did last year. Like, God bless, good luck." And the advisor's like, "My business grew 40% this year. what should I do? And the tax professional is like, maybe cut a check for this. That's not a strategy around how to pay taxes. In the tax world, there's two systems, right? There's the you need to file stuff on time so that the IRS knows what you owe them and that you're compliant on your filings for your returns. Then there's another system that goes on, which is the cash system of you need to be making payments so that you're satisfying the obligations that you owe at the right times. And there's different ways that you can do that. So you can do quarterly estimated payments. You can know what the cost is to not do the quarterly estimated payments and wait until the end of the year to get caught up because you'd rather have the cash in your business. And maybe if you're mid-year and you're like, hey, you know what? We have a good opportunity to hire a bunch of people. I want to use this cash towards hiring those people and knowing that my profit is going to go down. And therefore, I don't want to lockbox this estimated tax payments into the IRS. So you need to think about that. How are you going to be paying for them? And in one little trick that I want to give you is that you can take advantage of an IRA withholding scheme. So basically what it is you once a year you can take a distribution out of your IRA and have that distribution tagged to withholdings. So you don't get the effect of when you pay for estimated, when you pay taxes through withholding, it gets attributed as if it has been the whole year rather than when it's actually paid. Versus with estimated tax payments, like when you just cut a direct check to the IRS, it gets attributed when you pay it. And so if you're not meeting the minimum payment amounts, they will charge you some interest and penalties. But if you do it through withholding, they treat it as if it's been during the whole year. So you can do that through your W-2. You can also do that through taking an IRA distribution, which you have the custodian pay the distribution as withholding to the IRS or to the state. And then what you do after that is you reimburse the IRA plan for the amount that the distribution was to use it as a rollover. That's something you can only do once a year, but that can be a workaround if you want to wait until the end of the year in order to make the payments. You can get around it that way. And when you pay it back within the right time frame into the IRA, you're not subject to the penalty for the early distribution. You're not subject to income tax on that because it's a once a year you get to do this rollover. So little tip for you there. The quarterly estimated payments, I always recommend if you're going to be doing them, you want to prorate between two things, right? You need to know what that tax liability balance is and then deciding how you want to chip away at it based on what's going on in the business. So you need to know what that balance is, but then decide how you're going to chip away at it. If you want to, when you get those huge quarterly deposits into the account, maybe true up once a quarter, or just hold that money aside in a separate account, knowing it's earmarked for taxes and maybe waiting because you're not sure if you're going to be making investments into the business and you want access to the cash. Because once you pay that money in as an estimated payment, if it's an overpayment of your tax liability, you can't get it back out again out of the block box until you file the return for a refund. And then on top of that, when you file returns for refunds, you're subject to the IRS being the one that's instigating refunding you the money, and they're notoriously sloppy. So I recommend if you're not sure if you're going to need that money, you want to have a plan around that. And then we always game this in mind of what are the IRS interest and penalty rules, and making sure that when we're choosing how we're going to be paying these taxes, we have a plan around the interest and penalties and that you've thought about it. So that's the know where you want to go with the current liability piece. Now we're going to talk actual techniques, because those first two pieces really for me are the structural fundamental pieces you need to know before you can know, should we deploy a technique, yes or no. You need to know that liability, you need to have the plans around it. So let's talk about cashless first. So why do I break them out and emphasize cash? At the end of the day, when I do tax planning for an advisor, I'm optimizing for three things. The first thing is the value generation in the growth of the asset that is the practice. So I never want to do a tax planning technique that is going to take away from the value generation of the growth of the practice, unless there's some other strategic end to it, like there's other activities going on or something going on in their personal life. I always want to be maximizing the return in the asset that is the practice over the long term for what their goal is, for what's going on. The second piece is I don't want to run out of cash, because cash is oxygen for the business. And so if we run out of cash, it doesn't matter what else we do. The business it's not good. It's bad. So we're always optimizing for that first piece in light of the second piece, which is not running out of oxygen. The third piece is your mental sanity and your time as an advisor, because very often what I'll see people do is they will chase after tax benefits that are not worth their time. So, why emphasis on cash? I'll start with the cashless planning first. And then once we've run out of techniques that don't cost you cash, then we look at the cash techniques. And for the cash tax planning techniques, I always consider what is the opportunity cost of this cash in order to save this tax? Is it worth the planning outcome that will ultimately increase a value in the business? If the answer is yes, then I'm more likely to do it. If it's no, which would be like buying an SUV that you don't need, then that's going to be a no. So I always want to keep in mind that the cash burn needs to produce a return for me. And I always need to keep in mind the cost to the advisor, because their time has an opportunity cost, their attention has an opportunity cost, and you don't want to let the tax tail wag the business dog. But you do need to, the tax tail is there and it's pretty significant, especially in professional services. If you're paying upwards 40%, you need to pay attention to the tax tail. But what's the cost to the advisor and distracting their mental energy? So don't waste your time where it can be better spent growing your practice multiple for the sake of saving some tax waste. I see people stoop to pick up pennies, walking over dollars when it comes to tax savings. I want you to scrutinize activities that are pursued purely because of tax savings. Often I see this with real estate ventures that aren't fully thought out, or I see this with hobby ventures. You'd never want to use these activities, if most of the time, the amount of upside that you can get from increasing the multiple in your practice is going to way outcompete you getting distracted trying to save taxes and doing little hobby ventures and stuff like that. Unless those other things really spark joy for you, and that is a goal in your life to have those things, which is totally acceptable, that's fine. But I see people bring these things into their life without realizing the true opportunity cost that they trigger. All right, so let's talk some cashless tax planning techniques. These are the things I always go for first because they don't cost you much money. We'll talk about entity choice, S corporations. The biggest mistakes I see people make with S corporations: one pocket to another kind of deductions, things that you're already paying for, but are there ways for us to move them from a taxable pocket to a non-taxable pocket? So we're going to be talking about all of these other than loss and gain harvesting. I'd be remiss to not bring these up, but you know these as an advisor, so I will skip them. But just make sure you're not the cobbler's kids with no shoes, that you are doing loss and gain harvesting as it makes sense in your own portfolio for yourself. All right, so if you're a C Corp, pause the video and read this. I'm not going to go too deep into it. Things you got to watch out for C Corps. All right, S corporations, because this is where I get the majority of my questions. For the most part, partnerships don't really save you tax. It's not really much of a tax benefit to be in a partnership. It's more just like an operating vehicle. So people always tend to ask me about the S corps because there is pretty significant tax savings here, though the PTET piece applies for partnerships as well. So the basic mechanism for S corporations is they limit self-employment tax to the reasonable compensation of the owners, rather than when you're a sole proprietor filing a Schedule C. Even if you're an LLC, it's hitting your personal return. It's not going into an entity unless you elect that LLC to be treated as an entity. When you're a Schedule C, that self-employment tax just goes to the cap, and then the Medicare goes, ad infinitum, whatever your profit is. When you're in an S corporation, that whole self-employment component just gets limited down to what your reasonable compensation is. Now, what is reasonable compensation? It's like beauty is in the eye of the beholder. It's actually not. So a lot of advisors and a lot of tax professionals will say, oh, rule of thumb is this, or somebody told me to do 60%, or, we do, um, I do like just a nominal amount. When these things go to tax court, it always gets adjusted back to market compensation. What is a market-based rate for what you do in the business? And there are a number of different ways that you can calculate what a market-based rate is. I'll just cut to the chase. The tool I use is called RC Reports. It's something that's marketed for accountants because it's built for the IRS standards specifically for tax planning. You can send me a DM on LinkedIn and I'm happy to, help you with getting access to this tool since it's not really like marketed to the public. But it's something you want that market-based wage in there. The other thing that the S corporation allows you to do that's a huge benefit is it allows for a PTET payment in a lot of states. And I'll talk about what the PTET is in a minute here. So if you have an S corporation with a PTET payment, assuming you got a 6% state tax rate and you're married filing joint, so this is just napkin math to give you a sense of what these things can be worth when people are like, well, how much does an S corp really save? Um, if you have a $500,000 profit with 120 of owner's compensation and a PTET payment of around 30, roughly you'd be looking at saving about 10 grand federal taxes because of the PTET payment and 15,000 for the self-employment taxes. So that saves you about $35,000. And that's actual, preventing that cash from going out the door by having this structure for basically just filing costs. So it's a pretty good move if you can do it, if it makes sense, right? Part of it though is you got to do the napkin math ahead of time of, is this actually going to generate the savings? Yes or no? And is it worth the filing costs? But let's talk about other issues on the S corporation. So for owners, fringe benefits generally get added back to the income, which isn't that big of a deal, but people think, oh, I'm in an S corporation. Now I can write off a whole bunch of extra stuff. Not for the most part, right? The reasonable compensation piece is a serious issue. I see people, I think that's going to be an area that probably will get more scrutiny in the future. And then the other limitation with S corporations is there's limitations when dealing with multiple owners, which makes doing uneven distributions difficult. Because when you have S corporations that have ownerships, you have to distribute profits based on ownership percentages. You can't do unequal distributions like you do in partnerships. So a very common structure that I'm seeing more and more of is where you will have the operating entity on the top be a partnership, because that partnership can do uneven distributions. And then below it, under the umbrella of that partnership, each of the owners will have their own S corporations. And those S corporations allow them to take advantage of tax planning techniques. It also allows them to do things like, say, you've got one owner who wants to do this really expensive consulting program, this coaching program, and the other owners don't want to do it. By having that separate entity underneath, it allows them to do things like that, and it's not going to impact the other owners. Now, when you have these kinds of structures, it's really important to make sure the assignment of income is working correctly, because that's an area where advisors can struggle. So when you have an S corporation, so say if you're an IBD and you have an S corporation, there's restrictions in how that income can come through to you. So if you're an RIA, this is a non-issue really, because most, once you've got the RIA and all the registrations done, basically anybody you work with, they're going to be able to attribute that income over to the RIA, and then the RIA can do whatever they want. When you're not set up in an RIA structure and you're under a broker dealer, you're going to be stuck with different rules around how the income gets reported. And so the main question is just to go back to where you're earning your revenue sources from and ask them, hey, can any of this be apportioned into an entity? Could we have an agreement with an entity? And you could, instead of 1099ing me with my social security number, could you 1099 my entity with its EIN number? That's the question. And usually the compliance departments will be able to answer that one for you, whether or not they can reallocate it on the 1099. You want to make sure that you have agreements, if you do have an entity with whoever's giving you revenue, that entity is in the agreement, that the W-9 that you send over to them for how they're tagging things is the entity, that the bank account that the money goes into belongs to the entity. You just want to make sure that the cash is flowing where the income is going on the income tax returns. So you can have issues with assignment of income because oftentimes there might be portions of your business that you're not able to shift into an entity that still have to go on a Schedule C. That's okay. We can plan around that. There's actually some benefits to that oftentimes, but just know that you need to watch out for that. So another piece here is there, you can Google this, the Fleischer case. This was an advisor who got picked up in tax court. He wasn't paying himself a reasonable comp, and then also was assigning the income over to an entity, but missed a bunch of pieces, and that's a big whole thing. If you send me a DM, I'm happy to send you these slides with all these links and resources. There's a tax advisor article that I like, and there's also, I did a podcast episode on the Fleischer case talking about assignment of income issues for advisors. because this is one of those ones that if the IRS picks you up on having an issue here, they're not going to have a hard time bringing in a number of years, assessing self-employed, just making a mess of it. So you just want to be sensitive if you have a tax professional who's not scrupulous when it comes to assigning this revenue, because they might not be aware of this court case if they don't deal with advisors. They also might not be aware of the FINRA rules that are creating these restrictions requiring the income to go certain places if they're not aware of the restrictions that you have on your side that you can't move it over. All right, let's talk about the PTET. I've been waving this one around and not explaining it. So the PTET is the pass-through entity tax credit. It's basically, it's a live issue for 2024. For 2025, we'll just have to see. What this is it takes advantage of the loophole in the $10,000 cap in state and local taxes on federal returns. And what that means is on a Schedule A for your itemized deductions, if you spend more than $10,000 in state taxes, if you're in a high income tax state, you can't deduct more than $10,000 on that Schedule A. Now, what the PTET allows you to do, you have to look at state by state because each state is different. Most states you have to file with a voucher or an online system or file an election. You need to know what the state rule is. But the mechanism of how this works is it allows you to pay for your state tax, your personal state taxes, through your pass-through entities, so through your partnership or through your S corporation, in order to be able to take it as a deduction on the federal return, and then it bypasses that $10,000 cap. So it allows you to get around it. So the basic benefit of it is just whatever the limitation was that you weren't going to get, or even if you have the standard deduction, this is beneficial, right? Because now you're getting the benefit of a nice big standard deduction, and you're also getting a write-off on that corporate return for the PTET. So it can be even better if you're if you have a standardized, a standard deduction. But that's the basic benefit of it, is you save the federal tax rate. The IRS has basically blessed this, but look at your state by state. And then for sole proprietors who can't participate in PTET, something for you to consider is the cap might be getting removed in 2025, depending on legislation. If you have the opportunity, if you're trying to decide between, am I going to pay these state these state estimated taxes on December 31st or January 1st, you might want to opt into doing January 1st because it pushes it into 2025. And if the cap is removed, then it won't be subject to the limit if you're not already able to do PTET. So let's talk about one pocket to the other. Let's talk about QBI. QBI is one of those things where I'm not going to try to explain to you the mechanism by which it works, because this is like tax nerd basement talk. But what I want you to be aware of is it's a conversation that you should be having with your tax professional, and you should basically have a point blank question to them of, hey, I want to make sure that I'm getting the most out of this QBI deduction. Is there anything that I can do to change what I'm doing to make the QBI deduction better in a way that's not going to cost me very much? Because when you look at these thresholds, so for most advisors, if you're just purely brokerage income, you're going to get stuck in the SSTB threshold. So you have a lower threshold basically because of the type of business that you have. If your profit, if your income on your joint return is close to that threshold amount, is there a way for us to artificially lower that amount prior to year end, or do things like, retirement contributions or something to lower that so that we can take advantage of this deduction? Because if you don't use it, you lose it, kind of a thing. So you want to look at that. The other piece that I often see messed up is when people are statutory W-2 employees. If you have a lot of insurance income, those can potentially be eligible for the QBI separate from the brokerage income, just because insurance sales don't fall under the same rules as the as brokerage income. So you want to look at that and just look at, hey, is there any way we can game this? It's a question to the CPA. I've had some recent client cases with some significant statutory W-2 income that the prior CPA missed. It was costing this client I don't even know, like 10 to 20 grand a year for the past 5 years for something that was just simply an allocation and a checkbox on the return. So you just want to have that question of, are we doing as much as we can to take advantage of QBI? Because it is likely that this statute will get extended into next year too. One pocket to another, family members. So need somebody to lick stamps for a direct marketing campaign. So if you have kids, a common question that I get about hiring kids, The benefit to the hiring of the kids is that they get the standard deduction of the 14,600. So it's basically tax free. But the caveat here is you have to be paying them a market wage for bona fide services. So great ways to do this is if you're going to do something like a direct marketing campaign, if they can do some social media stuff for you. What's not going to work is just posting a picture of your cute baby on LinkedIn and then saying it's a $14,000 modeling fee for a post that got 200 impressions. That's not going to work. It's got to be something where you would realistically expect somebody, a normal business person without the family relationship, to make these payments, right? And it's a great way if you have kids and you want to get them involved in the business and you want to teach them some responsibility, give them some pocket money that you were probably going to have to pay them anyway, to shift this from your high tax bracket to basically a tax-free tax bracket. Another little bump here too is because they're going to have that earned income, you can have them do Roth contributions and they can end up basically getting that money tax-free, forever. But that's something for you to think about. You have to pay those market wages. You can't just cut a check for 14 grand to your 2-year-old. That's not going to fly. You get an even better benefit under sole proprietorships and your kids are minors. You can get around paying the self-employment tax. Another weird thing here is you do need to make sure that you're doing all of your reporting correctly. So the kids have to get W-2s, they have to file the tax returns, all that kind of stuff. Another thing for you to consider when hiring family or dealing with family is if you have a spouse who does not work outside of the home, maybe you have a spouse that doesn't have wages or generate their own, revenue. If you're able to hire the spouse and have the spouse do some things within the business for you, then you can look at them being able to participate in some retirement plans. So that's a nice little move. Also, if they need to build up, if they haven't been paying into Social Security, there is you can Google this. I'm sure ChatGPT could spit this out for you. There's a mathematical limit of getting a certain amount of Social Security contributions in to max out the Social Security benefit for when they're retirement age. The other benefit that you can get when you have a spouse working in the business is you can take advantage of medical expense reimbursement plans, which you can't discriminate. If you have other employees, you have to offer the plans kind of to all of them, but there are ways for you to be able to deduct medical expenses on the corporate, on the business side for a spouse if you have a MERP. But it's something where it takes some setup. If you have some significant medical expenses, it can be well worth doing. Something that you should also just make sure your tax professional is doing every year is taking a look at the married filing joint versus married filing separately. Filing statuses, because the number of times where I have somebody come in and they were working with another tax professional and they're just been married filing separate. And I ask them, is there a reason why you've been doing this? And they're like, oh, well, we just kind of like to have it separate. And I'm like, do you know that this cost you $20,000 last year? They're like, no, we did not know that. Okay, do we want to file jointly? Yes, we do. So don't assume that your tax professional is catching that and making the right choice. You might want to ask them about it, especially if you have significantly disproportionate income, or other things going on. Just make sure that that gets addressed. Other things for you to consider are 529 plans, HSAs, spousal IRAs, stuff like that. Just think about those things for me. All right. So one pocket to another, the sleeper. So this is one that I see a lot of tax professionals miss. And one that I see, a lot of people just don't talk about it or know about it, is cost segregation. And then the other one is gift lease back. And these are ones that are very specific situations they come up in. So if you self-rent your building, so say you own your own building that you operate your firm out of, there can be benefits to cost segregation studies. And basically what a cost segregation study is normally when you buy a building, you buy a property, you got to break out the land. We don't get to depreciate the land, but we get to depreciate the building. But typically, if it's a commercial building, we're stuck with using like a 37-year life on the building. And so what cost segregation studies allow us to do is say, hey, a lot of components within this building are not going to live for 37 years. They're going to live way less than that. Can we break out the components of the building and depreciate the components on their proper life cycles? And that's what a cost segregation study does. The nice thing about a cost segregation study is that you can choose when you're going to deploy that. So if you bought a building like 2 years ago, and this year is a boom year for you, and you're self-renting to yourself, and that self-rental is generating a profit, you can benefit from doing a cost segregation study to decrease the amount of profit that's getting kicked into the return from that self-rental. You can't take a loss on it, but you can decrease that self-rental income. And cash that chip in. Now, one piece here that you need to watch out for is there's talk about bringing back the 100% depreciation. So there might be a better benefit of deploying all of this into 2025 instead of 2024. So you got to watch out for that. For people who are interested in the self-rental rules, which are really nitpicky and complex, in the slides here is going to be an article for you to check out. So another piece that you should look at as well. So if you have elderly parents who you support or other family members that you know that you're going to be continuing to support, like disabled family members, et cetera, if you have property that your business is leasing, that it's renting or that you own, you have the opportunity where you could gift that property to a family member and then be able to lease it back from the business. Now, this is a lot more complex. It's hard to execute, but just know that this is something for you to look into if you have a family member that you're supporting on a consistent basis and property that you could potentially get into their control so that you're able to shift from you paying income tax, taking that post-tax dollar and giving it to them as support, to you being able to just pay a market rate for an asset that that family member owns. They get the benefit of that passive ownership. You get the benefit of the use of the asset. It's hard to get it above board. Like, you can get it above board. It takes some planning. Like, don't just go out and try to execute this on your own, but know that that's a planning opportunity for income shifting there that I see a lot of people just not even aware that you can do that. All right, so those are my favorite cashless planning techniques. Let's talk about strategic cash moves for tax management. So we're going to talk about retirement contributions, deductions, the good, the not great, and the ugly. They're not bad. They're just not great. And then we'll talk about some issues in the field that I've observed in the past for advisors. So retirement contributions, I'm not going to preach to you on this one. I'm going to leave it in your court, right? You have your own methodology and belief around retirement planning and what the benefit is and that sort of thing. My general philosophy, though, is just consider the opportunity cost of the capital. If you are a business owner, you run a firm, but you're a business owner, are you going to get a better ROI putting that money into a retirement plan, or are you going to get a better ROI investing it into the business? Is question number one. Question number two is, do you need to diversify your risk between investing into the one asset that is your firm versus doing something like a retirement account where it's diversified? That's question number two. Question number three, do you need to take advantage of, if you're just trying to diversify risk, do you need to take advantage of the pre-tax treatment, or is just investing into a regular brokerage account better because you're not lockboxing the money from yourself in order for you to get access to that capital in case something comes up prior to 59 and a half, where you'd get slapped with that penalty and have to pay income tax on it. So that's number three. Don't forget tax credits for employer plans. They're fairly small, but it's one of those things, if you're walking by, you might as well pick it up. If you are sponsoring a retirement plan or setting one up for your employees, make sure your CPA is picking up the tax credits for you. Also consider when you're setting up employer plans. So if you're going to do like a solo 401k for yourself, make sure that you've figured out the discrimination testing, because if you have employees or you plan to have employees, depending on what stage the business is at, if you're trying to use retirement plans to get better talent, just make sure that you've thought through not just this year, but what the next several years will look like in terms of the retirement planning. Multiple entities can be helpful with this too. And then I would be remiss to not say, if you are an advisor that is close to retirement or getting close to retirement, you always want to consider the potential benefit of a defined benefit plan, where you're able to sock away a lot of cash. They're really hard to unwind, and you have to make a commitment of the cash, but you can sock away a lot of money. And especially if your practice is at maturity where it's producing a lot of excess profits, this can be a really powerful move when you're in the years leading up to retirement. It's a big process to get them implemented, but it's can be extremely powerful for tax savings, especially if you expect to, you have a practice that's at maturity, you're expecting to retire soon. Maybe you do something like an installment sale of your practice, which is going to smooth your income. And then you're able to really drop your income, and it creates a really nice smoothing effect. So let's talk about my third tip, well, I guess this was my second tip in more depth, which is strategic growth deductions. So the best tax savings to me is when it comes to cash, cash techniques, is things that are investing in your growth. It's kind of like the strategy that Amazon used to grow, right? If you keep an artificially low profit margin by taking operating profits, spending some of that for investments towards growth, you're now only paying tax on this portion of it, while the portion that is the discretionary spending, that's the strategic growth, is now invested into the business and hopefully should be producing a return in the future that's going to increase the value of the firm by either increasing revenues or decreasing expenses. Basically, that's the goal, right? And so these things need to be strategic. This can't just be hey, we've got some extra cash. Why don't we throw 20 grand at a marketing something and see if something sticks? Like, obviously, you need an experimentation budget, which should be a budget. But I prefer when we've already plotted out okay, in the next 5 years, what are going to be the things that are strategic investments for us as a firm? Is it going to be software? Which people? You know, upgrading different platforms that we have access to, acquiring talent, having different consultants, like what areas of the business are going to need to be professionalized? How are we going to do that? So that when you get to mid-year and you say, okay, we've got excess capital to deploy, here's the next thing on our strategic list of deductions, and you just go for it, right? And then obviously you need to have guide rails in place where you're tracking KPIs, you're tracking performance, because in order for this to actually make sense, those strategic deductions need to be investments. They can't just be, guesses. And so when you have those strategic investments to lower that profit margin, that's going to improve your tax performance by a lot, but you got to be smart about it. So common ones like professionalizing, coaching programs, talent acquisition, outside consulting, and marketing. And that's something where if you have a forecasting function in the business and strategic planning, these are really important pieces. So those are the good. These are the not great. When you're doing those strategic reinvestments into the business, you could wipe out half of that taxable income and then in the next year get a 2x on that. Like you get way outsized return performance. These are things where it's just you're already here, take advantage of it, but it's kind of like the, picking up the pennies as you go kind of a thing, rather than that first technique. If you deploy that correctly, you can, if you do like Amazon did, you don't have to pay you don't have to pay taxes. Like if you get yourself down to that zero profit number, what's there to tax? So that's the not that I want businesses to run at a zero profit margin, but it's a game. Like you choose how you want to play it. So for the not great, we've got the Augusta, which is the self-rental of personal property up to 14 days tax-free. For this, the payments have to be reasonable. You can't exceed 14 days. You got a 1099, you got a record keep. It's often cumbersome. If you're a kind of person where you have a beautiful home and you like to host people in your home, maybe you have, a team that's all local and you like to host some holiday events and stuff like that, Augusta rule can be nice, but I wouldn't bend over backwards for it unless you have, live in a particularly high expense area and have a particularly high expense house where you could get a good deduction for it. Because like I said, the payment has to be reasonable. It has to be a reasonable market rate. Next one is auto mileage. I just recommend anybody who's going to be deducting anything related to any cars, anything, needs to get Mile IQ. I think it's something where the IRS is probably going to have more scrutiny on it in the future. And a thing that I see happen often is people will try to deduct 100% business use on a vehicle. You have to actually use the actual business usage based on the deduction. My favorite thing, and maybe this is like I've been invaded by Dave Ramsey thing, is I honestly just prefer to have low cost vehicles, because in my mind, when you just look at the dollars, I would rather save that money for another expenditure that's going to produce a return in the business. And I just don't see vehicles as producing a return. So for myself, like I've got a cheap Mazda CX-9 that I paid 20 grand for. And at the end of the day, a lot of the time with my, I'm remote and everything, and I don't drive very much for work, but often if you buy a lower cost vehicle and then you use just the standard mileage rate, you're going to get like a pretty nice deduction off of that. And in terms of cash over cash, if I take the difference in the cash and invest that difference into something that produces an actual return in the business, like a direct marketing campaign, that's a much better arbitrage. Now, obviously, if the big beautiful SUV sparks joy for you, or all of your clients are big beautiful SUV aficionados, like, go for it. You have my blessing, but don't just do it for the tax reasons. So, because I see some people are like, oh, shoot, I got a big tax bill. Let's go get an SUV. Don't do that. You're better off paying the tax. But if it speaks to you, that's a different story. All right, last one here, home office. Thing I see screwed up with home office is it just needs to be exclusive business use of the home office. Oftentimes when I find for advisors, it's one of those things where the juice is not worth the squeeze. When you're doing deduction planning for your personal residence, one thing that the juice is worth the squeeze is if you are doing consistent improvements on your home, keep a separate folder where you're keeping track of those, because when you go to sell that home in the future, if you exceed the gain exclusion on personal residences, which does not index to inflation as far as I can remember, you want to make sure that you're getting credit for all of those improvements that you put into the property. And on the home office deduction, just do some quick napkin math, because, if you're having to keep track of all these little like receipts and expenditures related to the maintenance and operation of your home, often it just makes more sense for us to take the standard rate on that, because it's literally, it's up to a $1,500 deduction. So if you're in the top bracket, that's $500 of taxes saved for the effort of one click in my tax software versus you having to like control all these receipts. So just something to look at, unless you have a particularly expensive home and like your office is a huge portion of it. Do some napkin math before you just kind of perpetuate the cycle of document collection for its own sake. The not great continues with tax credits. So the employee retention credit for 2021, yes, 2021, is still open. We will see what happens with that. But if you started your practice after 2020, it's something that might be a actually decent opportunity for you. It's going to take me way too long to talk about this program. So if you're interested in the employee retention credit, just send me a DM on LinkedIn. I'm happy to just triage it for you real quick. It is a potentially valuable credit if you have external employees who are not yourself, spouse, or family members. And basically, it can be up to $7,000 per employee for the first 3 quarters of 21. So it can be pretty juicy, but beyond the scope of this, just send me a DM if you're interested in that one. Electric vehicle credits, it's up to $7,500. If you're buying it through the business, you're not going to have that income phase out. But for the cost of electric vehicles, and especially if you're trying to max out the credit, unless you're buying the electric vehicle for its own sake because it is sparking joy for you, I like the electric sparking combo there. It's not worth going after just to get the credit, right? It's like, I'm going to buy 3 of these because I've got a coupon. So if it's there and you're doing it, make sure you do get it. Make sure it lands on your tax return. I've seen a number of these where people buy them, think they're getting the credit, and it didn't land on the tax return. The credit's also limited to manufacturer quotas. So you kind of want to make sure that it's actually going to work depending on what the quota is. You can look that up. Another one here is if you're doing employee health insurance or retirement plan credits, just make sure you're picking up tax credits where you're already doing things like the worker opportunity tax credit. If you're hiring employees on, just make sure that there's some part in the onboarding process with your payroll company that somebody's looking for these employee tax credits. Oftentimes nobody's looking for them, and they can actually add up if you're doing a lot of hiring. Also looking at state programs. So for instance, in Massachusetts, there's and I think this is still open, a training reimbursement program that pays you to train your employees, which is really cool. Just make sure that if your state has program, and you can just Google this or ask ChatGPT, right? Are there any programs for benefits for employers in my state, in my city, whatever, and just have that as part of your onboarding process when you're bringing new employees on. All right, the ugly. We're going to talk about deduction issues. So I don't know about you. I get my best tax advice from TikTok influencers. That's where I do all my best tax research. So there's a bunch of nonsense out there. I think at the end of the day, the rule of thumb that you just need to keep in mind whenever you hear people talk about deductions is when you're going to deduct something through the business, it needs to be ordinary and necessary to be deductible. And so if there was no tax benefit from doing it, would a normal person make this expenditure in the normal course of business? If the answer is no, you're probably going to have some trouble from the IRS if they pick you up. I'm expecting IRS scrutiny to go up, especially for households over 400,000 in income. We'll see what happens with the new administration, but they are implementing AI for enforcement, and they use, they've got systems using red flags and random audits. Big one I see here is assignment of income. When you have mismatches between the information they have on file, like 1099s, and the information that you're reporting on a tax return, that's where a lot of the red flags kick up, and you just automatically get pulled into examination issues. But just, be reasonable out there. Larger improper deductions like 100%ing all vehicles or personal travel or personal living expenses, clothing, household employees. So not employees of your company, but household employees or meals. You're not typically able to deduct those. It's very loophole cases that you can. And like I said, when you're thinking about whether or not you can deduct something, it comes back to that ordinary and necessary in order for it to be deductible. So that's what you want to look out for. So the ugly that I see people miss sometimes, and I've seen this actually be an issue for people in the past, is state unemployment agencies can be really aggressive if you pay a lot of people 1099. The IRS guidance is there in that link. If you want to DM me, I'll send you these slides with all the other links. You have to look at your state requirements because different states have different rules over who is an employee versus who is who's a contractor. When the IRS picks this up, what they look at is the three factors of the behavior: who controls how the worker works, financial, how are they paid, who pays for expenses, who provides tools, and then the type of the relationship, contracts, etc. If you have a lot of people that you pay 1099, this is something that it's worth just making sure you've got it down right, because if they pick you up for this, it could turn into a multi-year fiasco of them, trying to charge you for self-employment taxes if people weren't picking things up on their returns. If you were paying people cash and not 1099ing them, it can just get really messy. The IRS is just getting a lot more aggressive about, I think they're going to continue to get aggressive with like gig worker style things. So you just want to watch out for that. Another ugly is BOI reporting. So you just got to make sure you have a plan on the BOI reporting if you're subject to that. If you're not sure, just there's another if you go on the channel here, there's another podcast, maybe the magic of YouTube. They'll be posted somewhere in here, the podcast episode on BOI. You can go to file on fincen.gov/BOI. The fines can be up to $500 a day. And basically this is an information return where you just go into the portal and, this is the business, this is the owners, this is where we live, etc. There's a number of tools that will do the filings for you, but you just want to make sure you have a solution for that. For most businesses, that's starting at the end of the year is when that starts. But if you formed a business during this year, the deadline is way sooner. All right, so congratulations, you've made it 52 minutes in. We're going to talk about the bonus, which is looking ahead for 2025 TCJA and the return of Trump. So I'm a fan of the Tax Foundation for this. Their full plan is there if you ask me for the slides. And then I just copied off of them what some of the current provisions are. So they're expecting most of the things that are expiring. Is that even right? Expiring. Geez. Expiring permanent, except for the cap on the SALT limitation. So that $10,000 cap I was talking about earlier, they're not expecting that to, they don't want to renew that, which I get. But we'll see what actually happens. Specifically, big ones in here are going to be those standard deductions staying the same, the 199A pass-through. The estate tax change is going to be a really big one if they can keep that. And like I said, on thinking about cost segregation studies, restoring the 100% bonus depreciation, R&D expensing getting improved, just a bunch of other stuff. A couple pieces that are probably more relevant for your clients are going to be things like exempting tips, exempting Social Security benefits from income taxes is going to be a big one. Just a couple other pieces. The green energy subsidies piece we'll have to see. So what now? Step one from here, if this was a good presentation for you and you're interested in the work that I do as an advisor, as a tax professional who works specifically for advisors, say hello. I'm happy to send the slides, and usually I do this as a presentation for groups. So I usually do a Q&A and then send that out too, but I'll send you the slides and then you can send me your questions. Step two is I do an assessment for people. So it's like a one-page financial plan. And I'll just read you a testimonial I got from a recent client. I thought the assessment felt good. It didn't feel, pushy at all. Like it was extremely thorough. I mean, I never been through anything like that. This is verbal, obviously, like this with an accountant before. So it's certainly unique to me and anyone else that I've ever talked to. I feel like this is the thing I've been searching for so long and wanting to have is a tax advisor opposed to a tax filer. And this is what the relationship feels like. So I thought the assessment was excellent. So that's from a recent client of what the assessment is like, which you don't even need to switch your tax professional. It's just to get a second set of eyes on your situation, somebody under the hood to see if there's things you're missing out on, compliance flags, just advice that I have for you based on the planning that I see. Step 3 is I do proactive support, annual income tax filings, and advisor specific goodies. So people who come in as clients, we tend to produce things for them. So, office hours, special updates, stuff like that. Or we can just be friends online. So I'm very active on LinkedIn. You can find me on LinkedIn. Or if you're interested, you can join my sporadic tax newsletter for advisors. If you're interested in the 2025 activity that's going to be coming up, I'm going to be talking about that a lot over the course of the next 6 months. So you did a really good job. You made it the whole way through the presentation. So I want to say thank you. Thank you for listening to my tax rant. And I'm looking forward to getting to know you better. I love working with advisors and I love talking to them. So please do reach out, check me out on LinkedIn, and happy to, become a part of your world. But thanks for listening, and check out the channel for the podcast and other stuff that we've got going on. And please let me know, was this valuable? What did you take out of this? Anything useful? Anything surprising? Anything concerning? I'd love to hear it.